Well, even that has run out. And now what's driving the market are motivated sellers, and it's turning to distress because you're seeing foreclosures increase. And what I've been hearing from people on the ground is like there's a rage delisting. They're so angry that they're not getting the offers at the price that they think. They're like delisting it and thinking that those, Fed cuts are going to change mortgage interest rates, not understanding, even though they should have learned that lesson last year when the Fed cut rates, that the Fed does not control mortgage rates. The bond market does.
Okay, ladies and gentlemen, so today we have Melody Wright on our show, and we will discuss the overall economy, and then we will talk about the real estate sector. So, Melody, thank you so much for being on the show.
Well, thank you for having me. It's my pleasure.
Thank you so much. So, very busy times right now, so much happening in the economy, in the real estate as well. So, what's your macro outlook, Melanie, on what's happening right now, and what would be some of the things that you would be paying attention to right now?
Yeah, so I think all eyes right now are kind of on two things. One, the labor market. What we've found out here in the United States is that the labor market was much weaker than anyone realized. Although many of us in what we call financial Twitter, FinTwit, this is something that we have been talking about some time and understood that there are going to be deep revisions, negative revisions to the payrolls. What's happened in the United States is we've had since COVID just like lower responses to the surveys that we use to gather so much data. And it's really caused some distortions, including this birth death model they talk about that it's supposed to capture how many new businesses are created or die. But it's very corrupted by the gig economy here in the United States because what's happened is, and what most people don't understand is that unemployment claims haven't gone up that much because people have gone out and started driving for DoorDash and Uber, which pays more than what unemployment would pay. And so there's just been a lot of noise that's made it very difficult to see what's going on in the economy. But if what I do is I get out on the road and I drive all over the country and I talk to people, and what I can tell you is that the people in the United States are not confused about what's going on in the economy. Really, the upper 1% is doing just fine, but you're even starting to see distress in the upper 10%. But most people out there are sort of suffering under inflation, the cost of living increases. And, inflation is much worse than what we see in official numbers because they do so many different adjustments to make it look better. And so, people in the US can go to the grocery store and understand where we are with inflation. And that's really, it's hitting Americans hard. And so, right now, what you have is you've just had unprecedented stimulus in the United States that is just finally kind of petering out. It's leaving the system, as well as you've had things like, eviction moratoriums during COVID, mortgage forbearance that made credit scores look a lot better. And this is one of the big risks I see is that a lot of private credit use credit scores to give out non-traditional credit like buy now, pay later, not realizing that those credit scores were highly inflated due to all that stimulus and all of those moratoriums and changes in reporting, including around student loans, which when those things started reporting earlier this year, it was a big shock and wake up call to many people who saw themselves as a prime borrower or someone with prime credit. Suddenly overnight they were what we consider subprime in the United States. So you just have so many things going on. And you notice I'm not talking about the tariffs because yes, the tariffs are hurting farmers, they're hurting very specific populations, but in reality what you had is a consumer who was already tapped out, and the tariffs are just kind of like a side note because people already could not afford the prices that you're seeing out there.
Yes, and if you look at the fact that about 60% of Americans are not able to cover $1,000
Right.
emergency expense, and if something bad happens with the stock market or if the employment market gets worse, that's a recipe for disaster, really.
Right.
So it's yes, a very dangerous times indeed. And just in relation to the real estate, Melanie, so it looked like it sort of froze for a good while. where the balance was in between. So what are some of the things that you're looking at right now, and what are you seeing in the residential market?
Yes. And right before I go to real estate, let me just mention the stock market because you'll notice I didn't talk about that either because in reality, the stock market is not the economy, but it's so confusing when people look out and see what's going on there. And I think that's a combination of passive investment. These in the United States, we have the system where you have something called the 401k, where you contribute and then your employer matches. And so you just get a lot of times increases in the stock market that really have nothing to do with what's going on out there. Because at the same time, you're having more people than they've ever seen on record take out loans from those 401k portfolios. And so, okay, I just want to mention that too before I move on to real estate. And so, yes, you're 100% right. It's been completely frozen. I think one of the reasons people misunderstand this market so much is they think it's about your families. They think it's about first time home buyers, regular, people like you and me. But in reality, what it's about is about investors. And it's been like that for a very long time. And so when it's frozen, we often think, oh, what's happening? Um, and oh, it's all this locked in effect. Actually, not really. What it is that it's simply too unaffordable for most people to transact. The investors came in, really bid up the price, and so they aren't interested anymore because you have increasing property and taxes, increasing insurance, increasing replacement costs. We're now seeing increased energy costs here due to all these data centers. And so being a landlord is just not any fun anymore. And in fact, we had those huge disasters last year, including, Helene, Milton, and then the fires at the beginning of the year, which hit a lot of uh, real estate, a lot of short term rental or what we call Airbnbs. And so landlords are really deciding that this isn't the game they want to be in because they cannot cash flow in these environments if they cannot get low cost of funds in their debt, then they can't really make any money. And that's what you're starting to see here. And so it's starting to thaw because what happened is your first time home buyers could not transact at all. Essentially, lowest number of first time home buyers that they've seen since they started tracking in the 80s last year. That's 1980s. I mean, that's insanity. And then the investors pulling back. And that just meant you just really had those transactions that you had to do because of a life event like death, divorce, default. But in reality, those were frozen too because many people could still put off a decision. So they could say, this isn't the right time to list this property. Let me wait. Or maybe they tried to list it. And what I've been hearing from people on the ground is like there's a rage delisting. They're so angry that they're not getting the offers at the price that they think. They're like delisting it and thinking that those, Fed cuts are going to change mortgage interest rates, not understanding, even though they should have learned that lesson last year when the Fed cut rates, that the Fed does not control mortgage rates. The bond market does. And what did we see? The Fed cut and indeed yields went up.
Mm-hmm.
So but to your actual question, sorry about that. This year we're starting to see some thawing on the price cuts because the last 2 years, the only people that were transacting are the ones that they could afford it, or they were propped up by these programs, these government programs that subsidize that purchase. So they could get that higher price because maybe they took down payment assistance. Well, even that has run out. And now what's driving the market are motivated sellers, and it's turning to distress because you're seeing foreclosures increase and they get that foreclosure notice and they realize, oh my gosh, I might actually get a foreclosure, which you don't want that on your credit. And so they're turning around and cutting prices. But I know I said a lot, so I'll stop and see what you want to pull on there.
Yeah, so really good points, Melanie. And the story is very similar here in Ireland, where for a young person, it's almost impossible to buy real estate at the current prices. Um, so yes, it's definitely a renter's market for now. And you did mention, Melanie, that right now the risk to reward for investors may not be as good. And I like to talk about this example that measures in gold. Real estate is actually cheaper right now than it was in 1970s, which is very fascinating to me, which again shows that there are a lot of alternatives as well, and there's definitely way less work with gold than it would be with the real estate. So just on the interest rates, Melanie, if we could talk about this relationship between interest rates and the housing market and what would happen if the Fed does lower interest rates and if they do go down.
Yeah, so we're in a very interesting times, and I think out there you've got a lot of people wedded to their narratives. One, um, you know, the idea that they're going to have a flight to safety trade in the bond market, which will bring down the 10-year Treasury rate, which is what mortgages actually um, correlate to. And then there are those that believe that we are exiting a 40-year or more lower interest rate regime and going to higher interest rates. I kind of land in the middle. I'm not exactly what I can tell you is that the bond market has kind of divorced the Fed, and they've decided uh, it's so fascinating to me to read stories about, oh, the 10-year did this because X, Y, and Z. Nobody really knows that. You can't know that until you actually look at the data, which is always lagging. And what you're actually seeing here is you've had recent increased foreign participation. But I think what this is in the long end of the curve, because obviously, so the Fed, of course, we know controls the short end, that Fed fund rate, right? But the 10-year, of course, is the bond market. And I think what's happening right now is you've got stress in the system where potentially they might be needing to sell those 10-year treasuries to buy shorter dated treasuries to pledge as collateral because they need more liquidity. And so I know that's kind of confusing, but we have been stuck at this 4% range for some time when Bessent and the administration came in very clearly saying they wanted to get the longer end of the curve. And then all you can see in the media is, of course, Trump calling out Powell. But I kind of have a theory that this is like watching a wrestling match. Like both people understand what's at stake, and both people know they can point at each other. And so it's less contentious than it might actually look like out there, because it's cover for both of them. It's cover for Trump. He can point to Powell and say, oh, you didn't lower interest rates, so we're in trouble. And Powell can say, oh, tariffs causes inflation. Because when you asked me about the economy, I talked a little bit about inflation, but that is the other big concern of the Fed. And so what we just saw happen, which is almost what happened exactly last year, is the Fed made a cut and the 10-year sold off and causing yields to rise, which caused mortgage rates to rise. So I've got to be honest, in my years of studying the Fed and many economists, I don't think they control what people think they can control. And I think it's becoming abundantly clear. And I think you're also seeing a market that's lost confidence, at least in the bond market with the Fed, where the equity markets are just the wild, wild west right now.
Mhm. Thank you very much. And if we look at the current valuations of the real estate in general, of course, it depends on the location, but if you look at the big picture, can we use some metrics to measure on how low they could go in theory if it does decide to go down?
Yeah, so my last piece, I talked about that, and I think that people in the housing industry are way too excited about what they think could happen. They look at the people that have a over 6% mortgage rate, and that's about 18% in the market right now. Well, the problem is those people would have a lower mortgage rate if they could afford it, if they could qualify for it, is what I mean. And so, folks, really, you're not going to see massive movement in housing industry until you can really get below 4%. And to do that, someone would have to come in. You would have to have a combination of the 10-year going lower, as well as someone coming in and buying mortgage-backed securities. Well, that's what the Fed did. Back during the COVID boom, they also did that. as a tool to get us out of the great financial crisis. Well, the problem with the first time they did it, it wasn't all that effective. It kind of slowed things down, but it really, we were in too much distress. In COVID, it was more effective because you kind of had you had stimulus coming, fiscal stimulus coming. But in reality, that first 700 billion of like buying mortgage-backed securities got those rates down to about 2.65%. That's the lowest that they went. But then they bought 700 billion more and it didn't make a difference. They just rates kept floating back up. So some people believe that if you have someone like Fannie or Freddie come in and buy mortgage-backed securities, or somehow the Fed is convinced to do that again, even though they know it was inflationary in the last cycle, COVID boom, that you'll get lower rates. But in reality, you would have to get below 4% to make a real difference in the mortgage market. But most people just don't want to admit that the biggest issue in the housing industry are prices.
Hmm. And so on the bull side, people would talk about that there is a supply shortage. And then on the other side, people would say, well, the prices are too high. If you could give us some insight in the relationship between these two that are happening right now.
Yeah. So the National Association of Realtors and the housing industry have gone full court press claiming there's an inventory shortage. There is no housing inventory shortage. Sort of the average household size, when you just take how many housing units we have, and our population is 2.5. And that has been going down, 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 down for the first time this past year. That's stopped going down as you're seeing households consolidate because they simply can't afford it. But my point is, most people think the average household size is around four or three with, two people. And that's just not how it is anymore, because you have over 15 million vacant properties in this country. That's your second, third homes. You have another 3 million that are listed for seasonal use. And so there's a ton of inventory. It's just not maybe listed on these listing sites that we have in the United States. What's happening is you're getting a lot of private transactions because many of these properties are being left. So the boomers and even the silent generation are leaving them to, Gen Xers, the millennials, Gen Z. And so you don't even need a transaction in a multi. I know this is all very confusing, but I think that what's happening is, and you can drive all over the US, there's vacancy everywhere, vacant homes everywhere, as well as we went and built more supply than we have since the 70s for both multifamily and new homes. And we don't have the demographics to support it. We're not having, we're not birthing babies at replacement rate right now. And so just because the National Association of Realtors wanted us to think that there was a housing shortage, this narrative has been played everywhere, and it's simply just false. Now, are there affordable homes out there? No, they're not. I mean, people got so convinced during COVID that everybody was going to get rich. And in reality, that just wasn't the case. And so they all believed, because the investors were fully participating, paying all cash, that everybody was rich and could afford these homes. But now you've got the buyer saying, I can't, and the seller saying, listen, my home is worth X, even though I've done no updates and my roof needs replacing. And so that's why it was frozen. But what you're now seeing is just stress is going to start driving the narrative from here.
That's very, very interesting. And Melody, what could be could the stock market decline be the final pin for this real estate market as well? If we do, because if we do look at the stock market, the valuations are crazy, especially in the
Mm.
AI sector. So if you look historically, we should see a certain decline. Could it be 20%, 30%? We don't know.
Yes.
But if that does occur, I'm sure it should have an effect on how people feel about real estate as well.
I think so. And, but I think what we could see is some sort of credit event, which could precipitate that stock market decline. And so you think about a recent story out there in the United States about Tricolor, which was a subprime auto lender who lent to the immigrant population here, and they just imploded. And, Fifth Third had to take a massive write down, which was 10% of their overall allowance for loan loss. I mean, that is huge. JP Morgan, we don't exactly know how they've been impacted yet, but we'll find out soon. Several other big lenders. And so this is exactly the kind of thing that happened last time where you had suddenly distress in the system because our entire system is based on credit and confidence, right? And so what was very concerning about what they did is they pledged collateral to two different loans. And so, if you're JP Morgan Chase and you give me a big loan, Chase says, okay, I'm going to give you this big loan, but you've got to give me X%. You've got to pledge certain assets against this so you can take the money. Well, what this organization did is they pledged it to JP Morgan. They also pledged it to Fifth Third, or this is what's being alleged anyway. And it sounds like it happened. And that's where all of a sudden, let's say Fifth Third turns around and says, wait, you just defaulted on this loan. I'm going to seize these assets. And they realize they don't have any assets to seize because JP Morgan just took them already. And so that's when Fifth Third has to turn around, maybe borrow more from somebody like the FHLB or somebody. And you just have all this stress, liquidity stress start in the system. And so I think that we could see something like this, especially if the rating agencies wake up and do their job. I mean, I'm not expecting them to do it quickly, but what happened in the last, because I was there, what really triggered everything last time was when the rating agencies came in and downgraded all of the mortgage debt. And if they do that, to the subprime auto debt and even contagion into prime, then you could see very quickly some folks just implode. And so that could, then I think that's when your stock market would wake up to like, oh, wait, what's happening? And then, yes, of course, honestly, this whole thing has just been based on narrative and not reality. And so we just need some sort of event that actually creates awareness of what the true health is of the American economy.
Hmm. And for the younger generation, it's so difficult right now to just to come out of college, and their parents are probably advised them to buy real estate to start their families. What are you seeing, Melody, with the younger generation? What are they doing during their years? Are they getting involved in the real estate, or would they be mainly renting and not even thinking about it?
Yeah, so it was very different at the beginning of COVID. I would agree with you. There were a lot of people. I would talk to these young couples in their 30s who just went out and bought an extra house. And I was like, whoa, like, wow, that's, that's not something Gen Xers were really talking much about back then. And so when we were at that age, and so a lot of them tried to fix and flip it, but then they ran out of money to do the improvements, or so they sat vacant. So I think at the beginning they were doing exactly what you said. Their parents said, oh, get in real estate, or someone said this is the way to make money. It's also an inflation hedge theoretically. I mean, that doesn't actually work. And so I mean, I do think real assets are important to hold, but you got to understand what you're holding, and it's the land, not the actual home on it. And so, but I think that's transitioned now as things, as everything, as rent just kept going up, as home prices just kind of kept going up. Our younger generation is just pieced out. They're like, I mean, you can only go to so many open houses and get outbid before you lose all hope. And that is really what happened. I mean, people were distraught, just going to it over and over as the investors came in. And there were all kinds of tricks that the industry did. Like they'd list a property as coming soon, but in the back end, they were actually marketing it to people already. And so then you would call that day it finally got listed, and they'd be, oh, we've already had multiple offers, you can't. And so people are just so upset. And so right now, what most of them are deciding to do is, either their parents are still helping them, they're living with their parents, or they're renting. And they're trying house hacks, multiple roommates, things like that, just to kind of keep it all together.
Yes, you can compete with BlackRock.
That's right. That's right. But and they're starting to become net sellers. And what those guys did is for the past couple of years, they would sell to one another. And the reason they would do that is so they could kind of fix the price, if you know what I mean. hey, I'm going to sell this block to you, give me X price on it, and then you could turn around and get refinancing on that. And as a kind of an agreement, they would sell back some other portfolio to these guys, and they've just kind of been keeping that thing going. But we're getting to a point where it's the merry-go-round is it's getting close to having to stop because there's just no more access to credit.
Wow, that's fascinating. I would never think about that. Them just doing transaction uh, and really influencing the market. Yeah, that's super interesting. And so Melody, I would like, to bring some value for the younger audience as well. So if we could talk a little bit about some of the factors that an individual could look into when choosing a real estate in a certain area, just like on a macro level, if you could, please.
Yeah. This is so important. And it's, and I think that we've been, I worked in technology. I'm a fan of technology, but I think we've made shortcuts where people think that we have enough information by going to something like Zillow or Redfin or Realtor.com or Homes to make a decision like this. But you can't. You can't let other people make this decision for you because, people say, well, oh, is it in a good school district? Okay, maybe. But let's say you said that in Pasadena, California, and then, 2, 3 weeks later, you realize that school district, one of the big schools is closing because they don't have the funding anymore. I mean, it's just so much more important than that, like just looking at a school district. And so what we've done is we've kind of just tried to make these decisions. Like a lot of the people making investment decisions did it from thousands of miles away without ever going to visit those cities, which is biting hard now. But you need to familiarize yourself with a neighborhood. Like if you do say, oh, and by the way, just know that everybody's going to be like, oh, that's where you need to go, and you've got to discern that yourself. Like you need to drive around the neighborhood. You need to go talk to the principal of that school, sit down with them. You need to know, are they in debt, that school system? Are they going to be able to make payroll? Demographics is huge. Like how much of your area is owned by primary occupants versus renters? Because you could suddenly realize you don't know it. You just bought in a whole rental subdivision, and that change those neighborhoods degrade very quickly. So you have to know more than just, okay, do people tell me I want to live there, and is there a good school system? And so then of course price comes into it. But this just isn't something that you're going to be able to say to chat gbt or some sort of Zillow or whomever. Give me all the information I need to make this decision. You're going to have to get your hands dirty. And so what I would recommend to the people that feel priced out of the housing market right now is start your research, pick your area, believe that you're actually going to be able to live there, pick your area, start driving around. You'll notice that maybe there aren't a lot of houses on the listing sites like Zillow, but there's actually a lot of for sale signs. And there's other programs out there, one called Property Radar that's relatively cheap, that you can plug in an address and it's going to tell you, does it have a tax lien on it? Is it in distress? Has the owner died? You'll get a whole bunch of intelligence as well as even contact information. So you could reach out to maybe get in front of, other potential buyers. So it takes research and it takes legwork. And that's how you're going to be ahead of the game. And knowing too where investors are heavily concentrated, because that's where you're going to start to see price declines first. That's places like San Antonio and Atlanta. And in the markets that I track, that have a population over 500,000, Atlanta was number one for year over year price declines at over 7%, looking at Redfin. And that is because of all of those institutional owners. So knowing things like that. And so what I do in my Substack, and I try to include a ton of free data, a ton of data in the free section, because this really is more of a passion for me, that I want people to be able to afford a home, and I want people to understand and not get in over their heads but I also do deep city dives into various cities. And I walk you through my logic. You will be able to reproduce this to figure out, and obviously looking at things like unemployment, and short-term rental ownership. As some, I would never recommend anybody to buy in Mission Beach right now. For instance, there's over 12,000 short-term rentals in San Diego, and you're going to see prices decline there for some time. So it's complicated, I guess, is my answer. And you can't outsource this to Zillow. That's not how it works. And you're going to have to do some legwork. So I hope that helped.
Yes, great points, Melody. I will have all the links in the description for everyone who's interested, and I highly recommend to have a look. And so, Melody, I like to ask this question for the younger audience as well. If we have an individual who's still at the beginning of his and her wealth building path, they have so many options now with the Bitcoins, crypto, gold, real estate, and everything. Well, real estate, maybe I'm pushing it a bit with the current prices, but they have so many choices. And just what advice would you have for that individual on how they could start off their wealth building path the right way and not make too many mistakes and they'll get burned too fast?
Yeah, it's really hard right now. I would say, because when you're in these massive inflection points, for me, I'm a fan of the metals of gold and silver, but we've just had an incredible run in those assets, and so that could mean a correction. And so for many, it's hard to get in to that right now. Short dated treasuries, I think, are still an option. I wouldn't go out too long on the curve, because I am fearful about what could, happen long term to our debt. And then I think right now, money market funds are still doing okay. And so, but I guess it's hard, but I think you have to be in a defensive position, and just don't be overweighted, and also don't be too fragmented. Like, kind of do your research, figure out where would make the most sense for you and your long-term plans, because it depends. What are your goals? Like, are you trying to buy that house in the next 3 to 5 years and you need a certain amount of return? Or is this, I just need a safe return for the next 30 years? So talk to professionals is what I would say, but be careful about which professionals, because the sell side does not really have your best interest at heart. So again, it's going to take doing your own research and vetting. But for right now, um, I think this is a time when you need to be fairly cautious and not jump in, and be flexible with the ability to kind of pivot rather quickly. And what I would say right now is tech stocks are so dangerous, and they are, like you say, so overvalued. I would just say, tread very carefully there, because many of those companies like Nvidia, they do some very Enron like accounting practices, and we could wake up one day with another Enron on our hands. So I wish I had better advice, but I think it's right now is just a time to be very, very cautious. And if you can in some way get in on the metals, that would probably be my biggest suggestion. Understanding, though, they're very expensive at the moment.
Yes, and I always like to talk about the importance of having cash as well, because
Oh, yes.
even in the current environment when everything looks so expensive and we have this devaluation of currencies, still that's actually usually the periods when everything goes down. Well, not
Right.
everything, but when the valuations do go down, and having cash in those situations are so important. And that's actually how most people get rich, by being
Yes,
prepared for a situation.
exactly. That's what I mean. Be defensive. Maybe being all in cash. I don't, I right at this moment, and maybe getting the return in a money market account, like that to me is it's a decent bet, but also be though careful. If it's not in a bank, just there's just so much risk right now. But I do agree with you that being in cash in times like this, I don't think it's going to be a terribly losing proposition when you're looking at all of these valuations and things could just plummet overnight. And we are in some crazy territory right now in the stock market.
Certainly. And Melody, if you could share maybe an advice that you received that had the biggest influence on your wealth building path, or maybe just in general, something that had a big influence on how you started off learning about things like these and just in general.
Well, it's kind of radically different from probably a lot of people. But for me, my purpose comes first. And once I understand my purpose, everything else follows. And, I was in corporate America for many, many years, miserable, thinking that being able to take all those vacations, or that Starbucks every day was some kind of necessity because I was too tired to make my own breakfast or things like this. I just realized that wasn't a life. And so I think what we have to, of course, we have goals for our family, but I think we have to put our purpose first. And what is that purpose? And then how can we use that purpose to, support our families? And so it's not necessarily like it. Financial advice is that I would say, don't spend time fixating on keeping up with your neighbors. They're not happy. They may have a boat and a car, but that's typically leveraged. And, don't get that FOMO. Think about what you want for your kids, what you want for your future. And even if you don't have kids, but what do you really want? And then, figure out your purpose. And then I think everything else follows from there. And so I, I don't know. I'm not a real believer in extreme wealth. I've seen what it does to people. I've worked with many, many, many rich, filthy rich people, and they're never happy. They can't trust their own family. They can't trust people. There's always people trying to take them to the cleaners. A recent incident in my own family, modestly wealthy, they were targeted. So this is, wealth, in my opinion, isn't what's in the bank account. It's in your relationships and your connections to other. And so I know that's kind of cheesy. But honestly, I think if we started there, we would all be a lot wealthier.
Yes, Melody, I absolutely love that you went there because I'm a big believer in what you said, and the mindset is so important. I remember, Melody, when I started working on my first job, I was on the mindset where I would save 50% of my salary, invest, work really hard. And it's just an example that if you have a certain mindset and if you really want it, you can do things that look hard, but you actually get enjoyment from it. Like I absolutely love that period of my life where I wouldn't really buy much, but just the enjoyment from the process because that was part of my mission at the time. So
Right.
thank you very much for sharing that. So Melody, these are all the questions I had. Is there anything else that maybe we haven't mentioned that you believe that's important?
Just quickly, I will say here in the United States, this month is going to be the expiration of one of the most unprecedented loss mitigation workouts in mortgage that we've ever seen on the FHA portfolio. And the FHA is typically what should have been used for first time homebuyers. Unfortunately, investors were using it and committing fraud. And so guardrails are going in at the end of this month, come October 1st. A lot of people out there are not going to be able to get a solution when they call in and say they can't make their payments. And this will be very different from what's happened before. It'll take some time to see the impacts in the housing market. But by Q2 of 2026, we are going to see material default if there is not more government intervention. And so I would just say that I think things could accelerate from here even more to the downside. Now, I say accelerate; it'll be a slower acceleration, but definitely. And so that's just one thing I would tell people to start looking out for as well. But otherwise, I think we covered a wide range.
Yes. So again, thank you so much, Melody. I really enjoyed the conversation and thank you again for your time.
Thank you so much for having me. It's been my pleasure.